Singtel just reported FY2026 net profit up 40% year-on-year to $5.61 billion. On the same day, it told the Singapore Exchange it was open to selling a minority stake in Optus. These two facts arrive together, and the market is reading them as one story. But they are not one story. The 40% profit jump was driven almost entirely by a $2.84 billion exceptional gain from selling down its Airtel stake in India. Strip that out, and underlying net profit rose 12%. Solid, but not remarkable. More importantly, within that underlying number, Optus contributed positively, but not cleanly. Singtel disclosed that Australia generated an exceptional loss from provisions for regulatory and remediation expenses and costs related to a retail store buyback. So Optus is improving operationally. Revenue grew 2.1% to $8.35 billion. EBITDA climbed 6% to $2.36 billion. EBIT rose 23%. But Singtel is simultaneously making provisions against it, setting aside capital against the reputational and regulatory fallout still unwinding from the September outage, the 000 failures linked to 2 deaths, the cybersecurity breach, and the mis-selling scandal. This is the detail most coverage is skipping. The instinct in markets is to read a parent company's profit beat as a vote of confidence in the subsidiary. The unstated premise behind that reading, exceptional gains and underlying operational improvement, point in the same direction. Here they do not. Singtel's record profit coexists with provisions against Optus's liability tail, a tail Singtel is willing to share with a local partner. That is not a bullish signal for Optus on its own terms. It is a signal that Singtel is optimizing its own portfolio, and Optus is part of that optimization, not the beneficiary of it. The week before Singtel's earnings, a separate deal fell apart in Singapore, and it directly repriced the AU consolidation thesis. TPG Telecom's Singapore spinoff, Tuas, had been pursuing a $1.59 billion acquisition of M1 from Keppel. On May 22nd, Tuas terminated the deal after Singapore's regulator, IMDA, suspended its review. The reason? IMDA found that Tuas subsidiary Simba may have been using radio frequency bands it was not authorized to use, a potential breach of Singapore's Telecommunications Act. The surface reading is that this is a Singapore regulatory problem, not an Australian one, but that surface reading misses the chain. TPG Telecom spun out Tuas to hold its Singapore and international mobile operations. The M1 acquisition was meant to give Tuas, and by extension TPG's broader strategic posture, scale in Singapore's consolidating telco market. That deal is now dead, the long stop date lapsed, and Keppel is seeking new buyers. This matters for TPG's AU positioning in 2 ways. First, TPG's management attention and capital allocation thesis just had a major external variable removed. A successful M1 acquisition would have positioned TPG as a cross-border consolidator. That narrative is gone. Second, and more consequentially, the failed Singapore consolidation lands in the same week Singtel signals openness to a minority Optus stake. Market participants who were pricing a TPG-Optus merger path now have a cleaner binary to evaluate. Without the Singapore distraction, TPG's strategic optionality in Australia becomes the primary question. The Tuas collapse does not make a TPG-Optus deal more likely, but it removes the competing narrative that TPG was building a different kind of regional story, and that matters for how AU investors frame TPG's forward multiple. TPG currently sits at the intersection of 2 competing interpretations, and the gap between them is not about facts. It is about the unstated premise each side treats as given. The bull case reads Singtel's minority stake openness as a precursor to consolidation. The logic runs, Singtel wants a local Australian partner. The most natural local partner is a competitor who would benefit from combining networks. TPG fits that profile. A consolidated AU telco duopoly, Telstra and a combined Optus TPG, would have real pricing power in both mobile and fixed broadband. That would mean a structurally higher ARP trajectory for TPG's existing customer base, regardless of who controls the merged entity. The unstated premise here, Singtel's goal is to reduce its ownership burden while retaining strategic influence, making a telco-to-telco stake sale the path of least resistance. The bear case reads the same signal as an Optus recapitalization, not a path to TPG. The logic, Singtel is looking for a financial or infrastructure partner, private equity, superannuation, or a strategic infrastructure investor to take a minority economic stake. That is what the Brookfield conversations 2 years ago were about. It would inject capital into Optus, strengthen its balance sheet, and allow Singtel to retain operational control while recycling value, the same model Telstra used when it sold 49% of its mobile towers for $2.8 billion at 28 times earnings in 2021. Under this frame, Optus does not merge with TPG. It competes with it, now better capitalized. The unstated premise here, Singtel's language, long-term local partner, complementary capabilities, strong alternative operator, is designed to attract an infrastructure or financial investor, not a direct competitor. Both premises are internally consistent. Neither can be falsified by the articles currently available. The monitoring variable is not a price level. It is the identity of the first party Singtel is confirmed to have held substantive discussions with. A superannuation fund or infrastructure investor confirms the bear frame. A named telco or strategic operator confirms the bull frame. Until that disclosure, TPG holders are not positioned against a known outcome. They are positioned against an unresolved premise. That is a different kind of risk than a known catalyst, and it requires a different kind of conviction to hold. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.